Okay, guys, today I'm going to be talking about a topic so many people ask me about every single day, and that is how to leverage cash value life insurance like an IUL so they can buy assets like real estate, stocks, mutual funds, index funds, whatever your heart desires, business, so you can make more money. I've been searching for over a year of a video online that can explain this well, and it's been very, very hard to find. So I'm going to create that one for you guys right now. So I'm going to go ahead and share my screen here. We're going to start everything from scratch. Okay, how do I do this? Okay. So hopefully you guys could see my screen. So we're going to start off by creating an IUL policy. So the first thing you need to keep in mind, if you are working with a broker, you want to make sure they structure it minimum death benefit, maximum cash value. What this is saying is for however much premium you want to put into this policy, it's going to give you the least amount of death benefit allowed legally so you can minimize your cost of insurance and your fees as much as possible so you can make the most money possible that's compounding every single year, gaining interest. Okay, so that is step one. If they are doing balanced death benefit based on premium target, protection focus, they are scamming you. None of it works. Okay, if a client wants permanent coverage and their main goal is to get a high death benefit, give them a whole life policy. An IUL should always be max funded because it's created to help you make more money. So it's always minimum death benefit, maximum cash value. Okay. Next step. Let's say this person wants to put in, let's do something an average Joe can do, right? $500 a month. All right. So here, let's check this out. Here is the illustration. So here in this page, you're going to see a properly funded, a properly structured IUL. So all the way in the left column is the policy year. Second column is the age. Third is planned premium. So $6,000 a year. That breaks down to $500 a month. Accumulated value. This column right here is showing you how much money you have in your account. Surrender value is how much money you have access to by the end of that year. And obviously on the far right, the death benefit. If you were to pass away, your beneficiary, whether that's your spouse, children, your trust fund, whoever or whatever it is, will receive this much money tax free. Now, the first thing I need you to look at is the cost of insurance, right? So if the first year you put in 6,000 and at the end of the first year you have 5,319 in there, you're going to be negative for all IULs, for all life insurance policies, because they are giving you a death benefit. There's a cost of insurance. So let me show you exactly how much you're paying. So if you're putting in $6,000 a year minus 5,319, that year, your first year, you paid $681, okay, in cost of insurance. So you can get a death benefit of $174,000. I hope that makes sense, right? So if we divide this by 12, out of the $500 you're putting in, the insurance company is taking $56.75 as their quote unquote fees. So they give you 174K in death benefit for protection. All right. So now let's look at the accumulation, right? So this illustration is showing it at roughly 5%. So let's look 10 years from now, you would have put in $60,000. All right. Assuming the market grows at 5%, you would have $71,322 in your accumulation. And as you can see, you're 37 years old and you already have access to practically 99% of your money, 70,995. Okay. So as you can see already, it's not like a Roth or 401k where you're heavily penalized for accessing that money before you're 59 and a half years old. But right, the first thing I need you guys to notice is it is compounding interest, which means it's not a get rich quick scheme. You have to start it early and let it build over time. All right. So give it a few years before you use this money. Let it compound. So let's see here. Year 20, You've had this policy for 20 years. You would have put in $120,000. If you want me to prove it, I'll prove it right now. $6,000 every year for 20 years is $120,000. Assuming the market grows 5% the next 20 years, you would have your $120,000 would be $210,000. Okay. And you have access to all of it. Okay. Now I want to show you guys if you want to use this 210 grand to put as a down payment for a property, maybe do a fix and flip, or maybe you want to put it in the stock market because the market just crashed and you want to take advantage of it. Okay. I'm going to show you how that works. So let me structure it for you. All right. So what we're going to do, you guys don't need to learn all this stuff, but this is more so on the broker side. If your agent knows what they're doing, they would be able to do this very, very easily. Okay. So as you can see, we have more columns now. And remember, year 20, you have $210,000 in your cash accumulation and you have access to 210. But we saw a house. We were driving down the street in Tampa, Florida, and you see a house and you're like, you know what? I want to put a down payment of $200,000 because I have that much money in my life insurance. All right, let's see how it works. So as you can see, year 21, you decided to take a loan out against your policy. You did not withdraw it. You just took a loan out, collateralizing that death benefit. So let me show you what that means. You took home 200 grand. Okay. As you can see, your accumulation, the amount of money in your account is still 229,000. It didn't change, right? But your surrender value, the amount of money you have access to, dropped to 18,000 because you took out 200 as a loan. But you see here, this is what the collateral means. You see your death benefit, it dropped down by 200 grand. I wonder why. That means if you were to pass away at age 48, year 21, and you took out a 200K loan and you never paid it back, it doesn't matter. You don't have to pay it back because the insurance company collateralized your death benefit. Instead of your spouse getting 440,000, she's only going to get 240, right? Because you took out that 200K loan. Now, you might ask, well, what's the interest? It's a loan. So usually in your first 5 to 10 years, each carrier is different, expect a 4 or 5% interest rate. After 10 years, 2 to 3. So right here, you see the loan it has interest, just like any loan, guys, right? But you know what? The interest doesn't matter on this. You should pay it back, but you don't need to if you don't want to, if it's going to be a one-time thing. Because what happens is your cash accumulation, you never took your money out. You just took a loan. So your $229,000 in your account, it's still gaining interest, let's say at 5%, as if you never took it out. The equity is still in there, guys. It's still gaining interest. And why pay back the loan, the interest, if you're gaining more? So let's say you're gaining 5%, but your interest rate is 2%, you're still netting 3% every single year, right? So as you can see, it doesn't matter. Your cash accumulation is still going up. Your cash surrender value is still going up, even though you never paid it back. But let me show you how real estate investors use this. Okay, so they take out the $200,000, they put it in a property, fix and flip it, made 400 grand. What they're going to do is pay back this 200 grand into their policy, and they take home the remaining 200 grand. So let me show you that. Let's say it takes 1 year to do that fix and flip. Okay, let's look. Okay, so here we go. Year 21, you took out 200 grand. Boom, you bought a house. You flipped it. 1 year later, you put in 200 grand back into the policy. Okay, now you can see your cash surrender value went back up 200 grand, right? And your death benefit went back up 200 grand. And now the beautiful part is, since you flipped it for 400K and you paid back the 200, you just netted 200K in your bank account personally. And now, as you can see, if you want to buy another property in the future, you still have another 200K on year 23. And let's say you took a break, right? You're age 60 now and you're like, you know what? Let me invest again. Dude, you have access to 577K in your policy. That's over $500,000. You could buy a whole house cash, let it appreciate for a few years, and then sell it and still net a lot of money. And that's what infinite banking is, right? You take a loan out of your own policy, you pay it back, you make money, and then you put that same money and then invest it into another asset again. So let me show you the real estate infinite banking strategy. I'm going to just say it. I hope you guys can see it in your mind. If you have $200,000 in your cash surrender value, you see a house that costs $200,000. You tell your insurance company, hey, I want to take a loan out of $200,000 from my life insurance policy, collateralizing my death benefit. Okay. And they're like, okay, cool. Here's 200 grand, tax free, by the way. And what they're going to do is they're going to use that 200 grand, buy that property, and then fix it up, flip it, sell that property for, let's say, something more realistic, $250,000. So now they sold it, made 250 grand. And what they're going to do is, oh, since I used the 200 grand to take out of my life insurance policy, let me pay it back to my policy so I can use it again in the future. And that investor just took home $50,000 for himself. And guess what, guys? If he wants to do it again and take a loan out of his life insurance policy after that and flip another home, he can. That's what infinite banking is. It's when you take money out of your life insurance policy as a collateral loan, put it into something that will net a lot of money, like a real estate flip, crypto, stocks, whatever you are an expert in, your own business. If you have your own business, you can take loans out to fund it. Make sure it returns higher and then pay yourself back. You're your own bank. So that is the concept of infinite banking. I hope that makes sense.